All views, opinions, and comments expressed herein are solely those of the speakers and do not necessarily reflect the views or opinions of StoneX Group Incorporated and or its subsidiaries. This content does not constitute an offer or solicitation to open a trading account, to trade in any specific product, or to engage with any services provided by StoneX Group Incorporated or its subsidiaries. This content is not intended for residents of any particular country or jurisdictions where such content is prohibited.
Welcome to the Trading Global Macro podcast from StoneX, where we unpack the complex forces driving global financial markets. I'm John Kicklighter, Global Head of Content at StoneX.
And I'm Matt Weller, Global Head of Market Research for StoneX's self-directed brands. Each week in this podcast, we explore the macroeconomic trends and geopolitical events shaping Forex, equities, commodities, interest rates, and more. John, what is our topic today?
I think our topic today is one that you and I have probably been touching upon multiple times over the past years, and so has everybody else. It's when are we going to see recessions? And more explicitly, what are the leading signals of recessions? Obviously, recessions are severe economic impacts. They are contractions in the economy, defined different ways by different groups. I think in the United States, the NBER is designated as determining a recession in the United States. It was for the longest time considered to be consecutive quarters of contraction, of economic contraction, GDP contraction. But they clarified, I believe, I think it was 3 or 4 years ago. Do you remember exactly when it was, Matt?
Not to take us on a tangent to start, but I believe that became the colloquial definition. But even back to the 80s, I think there was a period where there were consecutive quarters of GDP that was not officially called a recession. So they had to re-clarify that colloquialism usually works, but it doesn't necessarily. That's not the official definition of a recession. And in very rare instances, it might vary. But honestly, it's close enough for government work in most cases.
Yeah. So it's generally considered that, but obviously there are considerations about the intensity and the consistency of the decline. And if it's broad, I think that's one of the considerations that they wanted to clarify relative to that expectation of 2 consecutive quarters. But we want to talk about not just an official recession, but what leads and earnestly leads those expectations. What is a good signal or sign that you have not a sure recession calling, but a higher probability? So that's going to be our conversation today. And I think the first thing we need to talk about is what is usually considered or is positioned to be a means of projecting those economic expectations, and those are leading indicators. So, what's your opinion on some of the leading indicators measures that we have? And they're pretty universal across major economies, at least. And I think in the United States we have the LEI, which is the most prominent. What do you feel about them, Matt?
I like the idea. Obviously, there's always an appeal. I am particularly partial to the ones that are more focused on market-based indicators. As has become a theme in this podcast, I believe that markets are always forward-looking and excellent discounting mechanisms that can sort of read between the lines on some of the economic data or look around the corner for what might be coming. So to the extent that some of these leading economic indicators include market-based prices, things like credit spreads, you'll notice here in the S&P 500, those are the ones I tend to put more stock into. But as you can see here, this official LEI leading economic indicator includes some other things that I think might be less relevant, or at least in this current economic cycle. And this indicator indeed has been suggesting that we're either in or about to be in a recession for the last couple of years. And I don't think the data, at least broad-based for the entire U.S. economy, suggests that was the case. So I'll kick it back to you, John. Any of these you're partial to, and what it's suggesting in our current market environment?
Yeah, the LEI is, the markets are really good at designating whether they really believe in something and then that they are going to take it as forward-looking criteria. You see it very much in whether the market actually reacts to the release of data. So when we take the leading economic indicators release, and generally this is true of most of them. We have them in Japan, we have them in the the Eurozone, we have in the UK, and so on. When we see these cross the wires, not even a blip, not even a blip on the dollar, the pound, and the yen. And I think it's because the markets don't really believe them to either be leading or they might seem to be inaccurate. When you look at the LEI's recession signal, which is when the indicator actually, the rate of growth actually drops below zero, or I think -5 is what it has here as a recession. You've had plenty of those, and to your point, it's been years in terms of contraction and no recession, which is kind of why there is also that clarification necessity from the NBER when people are saying, "What's happening here? We're preparing for this, and we don't see it." So I'm not particularly partial to this. It also, I think, to your point, in this particular cycle, different economic drivers were in the upswing, particularly post pandemic, that it can carry the economy forward. The feeling of economic health is something that's very often talked about in the economic or financial headlines over the past couple of years, where, and particularly the past year, where people will point to the record highs in equities, and yet the sentiment from households or sometimes even regular investors who are diversified, it's much more sanguine, if not outright concerned, and people feeling like it's a recession, even though it's not a recession because the official data suggests that things are going really well. So that all goes back to the fact that it's a different mix of what's driving the economy, and not everyone is a winner. But when you have a complex indicator like this, like the LEI, it doesn't really give you an adaptable and accurate reading. So sometimes you get a lot of false signals, which has been the constant, I think, from this over the past 4 or so years. So I'm not a big fan of the leading indicators, but I think it's also important to understand when we look at something like this, and we're going to talk about some that we think are important. It's worth considering who gets to call the official recession. And in the United States, like we were saying earlier, it's the NBER. So this is for those that are watching U.S. GDP, so year over year, annualized, relative to the official NBER recessions. Naturally, they tend to align pretty closely. And yet, you do have periods where you're getting close to or feel a recession. If you do it on a quarter-over-quarter basis, you will see that there have been some instances where you have the quarter after quarter contraction, and yet no official recession called by the group. So I think it's worth talking a little bit about what the group looks to in terms of its assessments to establish that. So, Matt, you want to take on what those components are?
Yeah, I am happy to do so. So, according to the NBER, they're looking for a prolonged, sort of widespread decline in mainly 6 indicators. Those 6 indicators are real personal income, non farm payroll employment, essentially, household employment. So, 2 measures of that NFP releases every month. Real consumption expenditures, are people spending money? Real manufacturing and trade sales, are people buying manufactured goods? And industrial production, are we actually making those things? And I do want to highlight here the idea of a recession sounds very official and formal and kind of like a you know it when you see it type of phenomenon. But as we've alluded to, there have been times where it's not clear if we're in a recession. And at the end of the day, it's up to the NBR Recession Dating Committee, which is 8 people, all of whom are professors at coastal universities, 2 of whom are married to each other, that kind of have become the official arbiters of this. But it's perhaps a little more squishy than something that's I don't know. Just when I actually looked into it, I was surprised by sort of how informal and perhaps subjective the process is. But those are the main indicators that they're looking at. So a lot of it's employment and spending, which makes sense in our economy here. I think it might even in our current economy be over indexed onto manufacturing. Of course, we are a service based economy here in the US. So, while we have seen a slowdown, if not a small contraction in manufacturing activity over the last couple of quarters, that hasn't really slowed down economic growth. So, that's something to keep in mind. if and when we start to see some of these other sectors of the economy slowing down, that unless manufacturing can pick up the slack, that might tilt the NBR committee more toward declaring a recession because they're so heavily emphasizing some of that manufacturing activity.
Mm-hmm. Absolutely. Yeah. So when it comes to those official measures, I think you can look at what I consider to be, or what we consider to be, time sensitive or more timely versus the old and stagnant and backward looking measures. So you mentioned manufacturing. So I think ISM, and there's also the Standard and Poor's measures that are a little bit more universal and global. And when you get that context and indexing, it is useful in a comparison of economy to economy. But I think the ISM are a little bit more respected in the United States. Also has a longer historical life. But you look at something like the manufacturing ISM figure, which actually at the time of this recording, we just had a new one come out today, and it actually jumped right back above 50, which is growth territory. But this is a timely proxy for GDP. So this is for the initial or the wrap of January and initial insights for the beginning of February. Whereas we won't get a first quarter GDP update from the U.S. until what, mid-April or so.
And that's just an estimate, which they'll subsequently revise in May and again in June. So you don't even know how the economy was growing until 180 days later.
And very recently, the estimates have been way off. So the revisions are substantial in a lot of these indicators, which is why reasonably there's a lot of criticism around the accuracy of the data. And I think the White House has been very aggressive in calling that out. But if you want to use something like the ISM, I think it's certainly worthwhile. But to your point, you make a very good point. If you're looking at activity in the United States, for example, we'll stick with the U.S. since we've been talking about the U.S. You probably want to look at service sector activity because services account for more than three-quarters of GDP and more than three-quarters of employment in the United States, obviously of different variations. So it's you do want to make sure that you're looking at the things that matter. And I think it's also called non-manufacturing. Non-manufacturing here's an employment figure, is going to be your more indicative and representative of the economy. To your point, are these measures or are these assessments accurate, or are they very distinct and obvious? No, not necessarily. It's about how you measure it and who's included in the measurement. But when you're looking at something like service sector activity, that's more indicative and more representative of the economy at large. So it's a better measure. So I think those are very useful statistics or data. I often reference them in my own analysis because they are time sensitive. They are generally representative. What other indicators do you like to look at that are timely and reflective of, with a good probability of economic health?
So I think those are good ones to look at in terms of timely measures of actual economic activity, in some cases survey based. But it will surprise no one, perhaps, that I'm going to go straight to market based indicators, things like ratios between different types of stocks or commodities that are suggesting where investors are positioning, because they're, of course, consuming all of this economic data we have in the past. They're also looking ahead. You have, hedge funds that get satellite data on how many cars are in each mall parking lot and aggregate that. So there's tons of data that we could never have access to, it even if we did, it would be on a delay. So maybe just to take a kind of a basic market based one, the ratio of consumer discretionary stocks to staples, and this is kind of logical. So if you think of a discretionary company like something like that's optional, that you buy when you feel flush. Maybe some of the car makers could be in here. Compare that to what would be a staple, so deodorant or Cheerios or stuff you might buy regardless of economic conditions. The ratio between how those groups of stocks are doing can indicate how investors are positioning. If they're worried that the economy is going to slow down, a lot of these equity managers still have to stay fully invested, but they can move to a more conservative position. They can buy Procter and Gamble and sell off their Tesla or whatever. And conversely, if they think the economy is going to expand, people are going to be spending more money. That's where buying a deodorant manufacturer isn't perhaps the most compelling investment. You want something that's going to get more operating leverage and generate more profits from an expansion. So I think looking at these types of ratios, such as the discretionary staple ratio, can provide a bit of a leading indicator that then you can confirm with some of this more timely economic data and be ahead of the curve long before our 8 professors decide that we were actually in a recession one way or another a couple months later.
Yeah. And I think market-based measures are, to your point, they're not just timely and forward-looking; they're also encompassing. So they take in all the known information. And if you expect an economy is going to contract, your investment in these types of assets are going to substantially decline, because you do not want to be on the hook for that collapse of not just your investment and your wealth, but also likely your income if it also leads to a contraction in the practical labor market. So I think you're right on. I'll also add into that some of the more traditional measures that we have from trading circles and always handing down old wisdom. You have things like gold versus copper in the commodity market. Gold is more of a haven or a speculative asset as well. So when you're looking at gold relative to something like copper, which is more of a staple, it's an actual economic activity and production, and it's a used metal, a practical metal. That kind of ratio will tell you that those spikes would indicate a recession. Which, interestingly enough, if you look at this, it's this ratio. It's kind of like the inverse of what you saw in the discretionary staples. The discretionary staples actually suggested that the economy is doing really well. This draws more scrutiny because it's suggesting that people are overindulging. This is more of a contrarian. You hit an extreme, and it's likely to rebalance kind of situation. But I think there's also situations which you can't always trust these indicators. I'm going to tell you right out, because right now I think there's a lot of conversation about gold and what's driving it. It's proxy to things like crypto was a very aggressive conversation. I think that's fallen to the backdrop recently. You also now have copper, which is being considered a component of the AI need. So it does diminish signal power of something like this. But this is, I remember somebody telling me about this 20 years ago and how accurate it was. And I would say, still waiting for this one. So this is a old world knowledge type of one, and I think there's also the spreads. So the yield spreads are considered, I think, a little bit more defined as being the actual measures leading into the NBER's official measures. The 10-year, 2-year is often quoted. If you hear somebody say 10-year, 2-year yield spread, or the 10-2, or 210, they flip it. I don't know why. But 210 spread, they're often referencing the difference between the 10-year Treasury yield out of the United States versus the 2-year Treasury yield out of the United States. And the difference is 10-year is usually considered long-term growth. 2-year is more about investment returns and a proxy to interest rate expectations, because that's the Fed's target duration. So there's a consideration there, and that's usually the investor's preferred measure. But if you look back into recent history, this inverted aggressively between 2022 and it exited in late 2024. Never saw a recession through that period, although it did come very close to the time that we had those 2 consecutive quarters of contraction, which those two things paired together really raise that kind of consideration, that concern. I think the economists' measure is the 10-year 3-month yield spread. That's because it's even in the shorter yield duration, you're getting into credit conditions and actual activity of the markets at the front end. And there's a longer history here of that being a stronger signal. Again, 10-year 3-month inverted aggressively for 25 months, consecutive months, no recession signal. So again, is this a broken indicator, or perhaps is this time different, or what is why the contrast, and why was this a very consistent indicator and now isn't? There's also a delay between when the inversion and subsequent writing of that yield spread occurs, and then the economy recognizes or spills into a recession. Um, and I think we've passed that duration as well. So none of these are great indicators, and they're not perfect indicators. But what do you think, Matt? I think we should end off on, do you think that there is a recession nigh, according to your calculations, not even the NBER's recession calculations?
You can always be surprised, but based on sort of a collage of all the evidence, I do not believe we're likely to see an imminent recession. Of course, that could all change tomorrow. I would have said the same thing in the start of 2020 before COVID shut us all down. But I kind of want to underscore your point here, and that's that some of these previously reliable indicators, by dint of being previously reliable, people put more and more stock into them, and almost to the exclusion of other indicators. So it's important in this current market environment, and probably for the rest of our lives, to kind of take a broad view, look at multiple different indicators, and then also think critically about whether they're still relevant in our current environment. We talked about things like employment. Now, if you're looking at NFP, we haven't been creating a lot of jobs here in the US, but you also have to consider the broader population picture, in that the population growth rate has shrunk. So perhaps only 50,000 jobs a month might be enough to keep the economy humming along, whereas in the past, that would be tipping toward a recession indicator. And we can look at the share of the economy that's focused on manufacturing versus services. Here, some of the Federal Reserve stuff, its balance sheet procedures and how it was setting interest rates may have impacted the difference between the 10-year and 2-year, or 10-year and 3-month yield. So by taking a broad picture and looking at a variety of different indicators, if you start to see, just one-off indicator turn red, well, maybe you don't automatically declare there's a recession coming, but you put your antenna up. And then if more start to tick that way, that's where the balance of risks might shift toward a recession, and it might be something you want to consider in your trading. But as is often the case in this podcast, I think we kind of undermine some of the historical evidence, and try to suggest a broader view and thinking critically about some of these rules of thumb that can be useful, but may not work in every single cycle.
Very wise. I will add, I think, a personal consideration of, I think, a tipping point. And you're absolutely right. You can't look at one thing and be utterly confident. I think that's a fallacy, and that's going to lead you astray. But I do think that we've had so much attachment to growth and economic health associated to wealth, in terms of not just individual personal wealth, but also the capital gains and capital market health. That if we have a significant market correction, I do think that it will push us closer to a recession than anything we have seen, at least over the past 5 years, so post pandemic. I think that is really where I'm looking as a tipping point for when you can actually see it. It will be a little bit more definitive. I think the NBER would start to get behind it, and those that have held out and said, "Oh no, the economy's doing great," because look at all these data and these metrics. I think even they will start to align to, I think, the low income average consumer, and say, "Oh no, we feel that," and that's when I think we start to see it. But we'll see. Thanks for tuning into the Trading Global Macro podcast from StoneX. If you enjoyed today's discussion, make sure to subscribe wherever you get your podcasts. I'm John Kicklighter.
And I'm Matt Weller. Join us again next week for more insights into the trends and events shaping the world's financial markets. Thank you.